Hello, everyone, and welcome to AI Explorer Journeys, our podcast where we navigate the world of artificial intelligence. I'm your host, Sarah, and joining me today is my co host, Kevin. Hi, Kevin.
Hi, Sarah. Hi, everyone.
We're witnessing something truly unprecedented in the tech world, an AI infrastructure spending spree that feels less like traditional investment and more like an existential arms race. NVIDIA, for instance, has hinted that global spending on AI-related data centers could skyrocket from about $600 billion today to an astounding $3 to $4 trillion per year by 2030. That's a 50% compound annual growth rate, a figure that, frankly, sounds like wartime-level investment.
You're absolutely right. And this isn't just about having deep pockets. It's about survival. For these tech giants, AI spending has moved beyond simple ROI calculations. It's about staying relevant in the next era of technology. The market isn't looking for dividends or buybacks from these companies. It's demanding investment in future growth, and AI is unequivocally that future. A prime example of this commitment is something being called Project Skygate.
Okay, tell me more. The name alone sounds epic.
It is. It's this massive initiative led by Masayoshi Son of SoftBank involving OpenAI, Oracle, and NVIDIA. They're planning to invest a staggering $500 billion by 2029 to build AI super data centers, with an immediate $100 billion injection to kick things off. To give you a sense of the scale, OpenAI has committed to purchasing $100 billion worth of NVIDIA hardware. That's enough to deploy at least 10 gigawatts of new AI data center capacity, which is the equivalent of something like 4 to 5 million GPUs. They are literally building the GPU factories of tomorrow.
10 gigawatts, 4 to 5 million GPUs. That's like building an entire city's worth of computing power. It really does feel like an arms race. And you mentioned Oracle in that mix, which is interesting. I saw their stock skyrocketed recently. What happened there?
Right, it's a fascinating subplot. People might have considered Oracle old tech, but they've just surged into this space. Their earnings call revealed their backlog, what they call remaining performance obligations, jumped to $455 billion. That's up 359% in a single year.
Whoa, where did that come from?
Well, it turned out OpenAI signed a huge multi-year deal with them for cloud capacity. We're talking about providing 4.5 gigawatts worth of data center capacity, valued at roughly $30 billion a year. It was such a massive win that Larry Ellison's net worth briefly surpassed Elon Musk's after the news broke. So yeah, Oracle has suddenly become what people are calling the fourth cloud provider, a major player in AI infrastructure.
Grandpa Ellison beating Musk. Who would have thought? But it really does show that for these giants, sitting on cash is a death sentence. It's innovate or die. But with such massive capital outlays, the question of actual returns has to come up. All this spending is exciting, but is it actually profitable?
You've hit on what many call the ROI problem in AI. Skeptics love to point this out. They'll say, look, from 2021 through 2024, big tech spent roughly $274 billion on data center capital expenditures. Yet, the estimate for AI-driven revenue in 2025 is only around $128 billion. On the surface, that's less than a 50% return, which doesn't sound very compelling.
I see. That's where the headlines saying AI investments have negligible returns come from. The math doesn't seem to add up.
Exactly. But that $128 billion figure isn't the whole story. The truth is, AI is already creating immense value, but much of it is embedded within existing business growth, rather than showing up as a shiny new AI line item on a spreadsheet. It's like a hidden engine.
A hidden engine, I like that. Can you break that down for me? Where is this hidden value being created?
Well, the biggest chunk, over 60% of that $128 billion, so about $82 billion, comes from enhancements to core businesses, especially advertising. Think about companies like Meta. They spent billions on GPUs for Instagram. And what happened? User time on the platform jumped from 40 to 55 minutes a day because the AI-powered recommendation engine got so much better. More time on the app means more ads served, which means more revenue.
Ah, so the AI investment doesn't show up as AI revenue, it shows up as better ad revenue. It was there all along, just disguised as normal growth.
Precisely. And that's just one piece. Another $20 billion or so is coming from AI cloud services companies paying Amazon, Microsoft, and now Oracle to use their AI models and infrastructure. That segment is growing around 28% annually, which is as fast as the software as a service industry grew in its golden era. Then you have about $13 billion from direct subscriptions to things like ChatGPT, and another $11 billion from new AI-powered software like Microsoft's Copilot. So the money is there. You just have to know where to look.
That makes so much more sense. It's not one big pot of gold, it's more like 1,000 little streams feeding into the main river. And I imagine the big institutional investors understand this distinction. It must be influencing how they invest.
That's a crucial point. Funds like Coatue, Whale Rock, and Altimeter have had wild rides with AI, but they're all betting heavily on it. And they share a consensus. The market still dramatically underestimates the future demand for AI compute. The real backbone, the chips, the energy, the infrastructure, they believe it has tremendous room to run.
Let's talk about that. I heard about Whale Rock having a roller coaster of a time. What's their story?
It's a great case study. In 2022, they got hammered. They misjudged how fast interest rates would rise and lost almost all the gains they'd made in the previous 16 years. But they held on to their core AI infrastructure plays. And in 2023 and 2024, they came roaring back. They didn't just bet on the obvious names either. One of their top holdings was a dark horse pick called Celestica, a lesser-known company that makes hardware for data centers. It shows they're digging deep into the supply chain.
So they're betting on the picks and shovels of the gold rush, not just the gold miners. What about the other funds? I'm particularly curious about Coateue's strategy. I heard they did something pretty clever.
They did. Coatue was one of the first big funds to recognize the coming AI power consumption problem. They realized that all these new AI data centers would need a colossal amount of electricity. So, by mid-2024, they started investing heavily in energy and power companies, names like GE Vernova, which makes power turbines, and Eaton, which makes smart electrical equipment. They basically anticipated a huge bottleneck in the system and invested in the solution.
That's brilliant. They saw that AI needs electricity and bet on the power grid. It's a non-obvious move that paid off. So, what can we, as individual investors, learn from these institutional playbooks?
Well, we can't replicate them exactly. We don't have their research teams. But we do have advantages, like flexibility and patience, since we don't have to report quarterly performance. The key is to adopt a disciplined approach. First, you have to filter the fire hose of AI news and focus on what actually matters. Second, use volatility to your advantage. When there's a panic or a negative news cycle that hits AI stocks, like that DeepSeek scare that temporarily tanked NVIDIA, that's your moment. If you've done your homework, that's the time to pounce, not panic.
That's easier said than done, of course. It's hard not to get swept up in the fear. You also mentioned managing risk. For someone who's excited about the AI boom, the idea of hedging or diversifying might feel like you're leaving money on the table.
I get that, but survival is the name of the game. You can't ride the AI boom if you get wiped out by a market correction. The pros often advise keeping your overall market exposure, your beta, at maybe 30-40% in uncertain times. That might mean holding more cash or diversifying into non-AI stocks like healthcare or even defensive assets like gold. It protects you on the downside. The goal isn't to be 100% right. It's to stay in the game long enough for your big bets to pay off. And that means accumulating the irreplaceable winners, companies like NVIDIA, Broadcom, and TSMC, when you get the chance, at reasonable prices.
That's incredibly sage advice. It's about being strategic, not just reactive. To make this more concrete, let's do a quick lightning round on some of the big names. How are the serious funds viewing them through this AI lens? For instance, Apple. They're a tech giant, but they seem quiet in this space.
You're right. Apple's absence from the core AI portfolios is notable. They haven't made any splashy AI moves or huge public infrastructure investments yet, so they're not really seen as an AI play. On the other end of the spectrum, you have Tesla. Despite all their talk about AI for self-driving, most institutional investors avoid them. The stock is just too volatile and unpredictable. Its behavior is more like a meme stock.
Okay, so who are the darlings then?
The absolute cornerstone is TSMC, the Taiwanese chip manufacturer. They're the arms dealer in this gold rush, making chips for literally everyone. Then you have Microsoft, which is often seen as the strongest long-term bet because of their deep partnership with OpenAI, but their stock is expensive. Google is seen as more of a potential value play. They were lagging, but are now catching up with their own AI models and chips.
And what about the others? Meta, Amazon?
Meta is an institutional favorite right now. They have a unique advantage because they can directly monetize AI through their massive social platforms like Instagram and Facebook to drive user engagement and ad revenue. Amazon is viewed as the steady, reliable giant. It's the cloud leader, and while it gets less AI-specific hype, it's a solid company that will benefit regardless. It's all about understanding that each company has a unique role, moat, and risk profile.
This has been an amazing tour of the landscape. It seems the AI pattern in the US stock market is becoming clearer. First, this whole AI compute arms race is really an existential imperative for these companies, not just a casual investment.
Exactly. It's innovate or die, and it's reshaping the entire tech world, even elevating unexpected players like Oracle into key positions.
And second, the true economic impact of AI is often underestimated because so much of its value is hidden, embedded in improving existing businesses like advertising, rather than showing up as direct AI revenue.
Right. Understanding that hidden value is key, and that's what the smart money is focused on.
Which brings us to the third point. Institutional strategies are clearly pointing towards the picks and shovels as the core long-term bets, the chips, the networking gear, and now, even the power infrastructure. They believe the demand for these foundational elements is far from peaking.
Well said. It's an exciting new world, with AI shaping up to be the new electricity for the economy. Those who manage to ride this wave thoughtfully could see great rewards, but we must always respect the risks.
The AI boom is not merely a technological advancement, it's a fundamental re-architecture of our digital and economic world, akin to the dawn of the internet or the mobile revolution. This era demands a nuanced understanding from investors, moving beyond superficial metrics to grasp the profound, often hidden shifts occurring beneath the surface. As we navigate this period of immense capital allocation and rapid innovation, the ultimate question remains: will humanity's ability to ethically and sustainably harness this new electricity for progress outpace the inherent risks of such a profound and rapidly evolving technological dependency? All right, that's it for today's episode. Thanks for tuning in, everyone, and thank you, Kevin, for the great discussion. Before we wrap up, let me remind everyone today's discussion reflects personal views only, not investment advice. Please consult professionals before making financial decisions.
That's right. Thanks for tuning in to the AI Explorer podcast. If you enjoyed this deep dive, don't forget to subscribe to our YouTube channel. That's all for today. See you next time.